Well, thanks for joining us on Bloomberg Quint. We are trying to get your opinion from global market men as to whether what's happened in North Korea yesterday and the resultant exchange of words and rhetoric from a bunch of global leaders, whether that will result in markets correcting significantly, or will the markets pause and wait for the tensions to escalate, if at all, because we've seen instances of such exchange of words and actions, for that matter, happen in the past as well. Remember, North Korea and the United States have been in a bitter war of words of sorts. Yesterday there has been a nuke test, unprecedented of sorts in nature, and a lot of nations have spoken about there being some sanctions which need to be added onto North Korea's existing list of sanctions. To talk about the market impact of this, we have Hans Goetti. He joins us right now, independent research consultant from Singapore. Hans, good morning, and thanks so much for joining us on Bloomberg Quint. What's your thought? The Asian markets have not reacted too violently. There is a tinge of red, but not a sea of red, something that a lot of people thought would actually happen. Why is this? Is the market believing that, again, let's wait and watch whether this escalates into a full-blown crisis or not?
Well, political events tend to have a very short-term effect on markets. Yes, of course, this is an escalation in the Korean crisis, but don't forget, it's very hard to stop the North Korean regime from doing what they're doing, as long as the United States and China, Japan, they're all on opposite sides. So far, nothing has worked. Sanctions haven't worked. And I think what we have to bear in mind is what North Korea wants. The only thing they want is essentially the survival of the regime and getting something out of it. I don't think anybody is interested in a nuclear war, although things can happen by accident. But I think markets see through that, and the reaction, in our view, will be relatively short-term here.
Yeah, but even if, so that's my precise question, Hans. A short-term reaction should be naturally that, short-term in nature, but swift. Right now, we are not seeing any swift reactions. The markets are pretty sanguine about what likely could happen, because even the SGX Nifty or the Nifty on pre-open or the Asian markets have not corrected over 1% at all.
Well, where we have seen the reaction is in the treasury market, in gold, in the currencies, not so much in equity markets, I would think. And as I said, I think these political events, unless they completely go out of control, have a relatively short-term impact. And look, the fact is that global central banks, maybe with the exception of the Fed, are still extremely accommodative. They're still buying assets, and there's still liquidity coming from that side. So the equity bull market remains intact, although it's getting a bit long in the tooth, but it seems to be remaining intact for now.
Okay, here's to show you what Hans was just speaking about. This is what the asset classes across the world are doing right now. So some bit of an uptake. This is showing you all the soft commodities, but even the hard commodities. So steel, for example, is bumped up a bit. Gold, if you look at this particular chart, we'll show you this is the 3-day move. There's a bit of a bump up in the safe haven assets, as this is indicating as well. So there's a bit of a bump up in safe haven assets. This is the gold chart over 3 days. But what's important is this bump up that we've seen in the last 24 odd hours. But across the board, a bit of red, but none of the global markets which are trading, be it Nikkei, be it South Korea, be it FTSE or otherwise, have reacted over 1%. And that is the point that we are trying to make, that the equity markets are actually taking this in a fairly decent manner. Now, Hans, my question is, if indeed the countries which are meeting right now to figure out if they should put more sanctions on North Korea, if indeed they do take that step, even if it doesn't go to a full-blown war, which I hope it doesn't, really, ideally hope there is no conflict of any nature between the US and North Korea, but assuming that there are some further trade sanctions, will the markets read too much into this, or then this is business as usual?
Well, we've had sanctions in the past. We had a build-up of sanctions recently. Maybe we get more sanctions on top of the sanctions. The truth is, these sanctions usually do not work the way they are intended to work. And I think the markets are seeing through that. And as I said, political events tend to have a short-lived impact. What is more important is what the central banks are doing, and that's what is dominating asset prices still at this point.
So unless it reaches a war situation, which, again, I'm sure you and I both hope it doesn't, there is no reason to your mind for the markets to be unduly worried about.
Absolutely, absolutely. I mean, if you look at some of the safe haven assets like gold, for instance, we think the fundamentals for gold look good regardless of the political tensions, because it has become increasingly clear that the Fed will not raise rates in September and probably will not raise rates in December either because the US economy is slowing. So I think from that side, there's some support for gold, probably also some support for US Treasury bonds. But again, these are driven by fundamentals and not by politics.
Okay, Hans, the other bit is I heard you mention in a previous answer that you believe that the equity markets are moving up as a result of other factors, namely the liquidity situation and the central bank action. But you did also mention that it seems to be getting a bit stretched. We've had multiple other people say that the US markets look slightly vulnerable. Indian markets seem to have run slightly ahead of themselves. And that's the view for a bunch of other markets too. Do you think the market is looking for a reason to correct? Or certain markets are looking for a reason to correct?
Well, the thing is, we've had this mentality now for years that the buy on the dip was a winning strategy. Yes, the U.S. market is stretched. The U.S. market shows fewer and fewer stocks are actually leading the whole market higher. Valuations are stretched. But then you have Europe, you have Japan, you have emerging markets, where in our view the outlook is a lot better. Japan, for instance, growth is picking up, earnings momentum is there. Valuations are attractive, and emerging markets are benefiting from a weaker dollar and stronger growth than developed markets. So I think there are opportunities in global markets. They may just not be necessarily in the US.
So the earlier stance, Hans, I remember at least maybe 10 years ago, or maybe even 5 years ago or 7 years ago, was that if the US sneezes, the world catches cold. If the US markets were to correct, not meaningfully, but to correct a bit, do you think there will be an ensuing correction in the other markets as well? Or after a brief reaction, other stronger markets could actually move in a different line compared to the US markets?
Yeah, exactly. I think the initial reaction would always be in sympathy with the US, but after that, we will probably see a divergence. And again, I think emerging markets for us look good. We have in the BRICS, you have real economic growth of about 5%, earnings growth, and you have a weaker dollar. So I think emerging markets would decouple, and in a way they have already. So I would think the emerging markets will outperform developed markets for the next probably several quarters, if not several years.
A last question, Hans. What about India? Have you had a look at all the developments recently? The earnings season is over. There has been a cabinet reshuffle and a few other things. So what are your thoughts?
Yeah, I mean, of course, the earnings have not come through, that we know that, but the market has a forward-looking bias. And looking forward, we still remain constructive on India within an emerging markets context. So I think we remain bullish on India in the long run.
Okay, great. Hans, thanks so much for joining in and giving us your thoughts. Really appreciate you taking the time out. I think the sum and substance of this interaction was with Hans Goetti is that he's saying that until this escalates into a full-blown conflict, which clearly all of us hope it doesn't, there is no reason for the equity markets to react too negatively, and maybe, just maybe, the markets will not react negatively too much. Well, we've seen a bit of a reaction in the red today. Let's see if the day is as usual or whether there is some further reaction that happens over the course of the next few days once the US markets start trading tomorrow. Remember, the US markets are shut today on account of Labor Day, so they'll not be trading today evening India time. They'll be trading tomorrow evening India time. Maybe, just maybe, we have some reactions on Wednesday and not necessarily today, if indeed the US markets were to react to this piece of news and the ensuing developments. But for now, it remains sanguine. Thanks a lot for joining us on Bloomberg Quint.